Hello and welcome to Market Domination. I'm Josh Lifton, live from our NYC headquarters. Washington still reeling from the firing of America's top economic data collector. We're looking at what's ahead in this important role and how the conversation is impacting markets. Right now, there's just an hour to go until the closing bell, and stocks they are moving higher here. Just looking at the popular averages, your Dow's up about 500 points, the S&P 500 up about 1.3%, your tech-heavy NASDAQ tacking on about 1.8%. Let's welcome in now. We got markets reporter Josh Schafer, we have Washington correspondent Ben Worschel, and our data and markets editor, that would be Jared Blikre. They are all joining us throughout the show to break down the headlines. Jared, going to start with you, my friend. Give us a lay of the land on today's trading action so far.
Yes, it is risk on. We're going to see that expressed across the board. As you said, the Dow up 500 points here. The NASDAQ up even more, 1.79%. That's almost 2%. S&P 500 about 1 1/3, and the Russell 2000, let's get that in there, 1.8%. But I just want to show you something really interesting today. Friday, this is a 3-month chart of the S&P 500. Since about the middle of June, we had really low volatility. Every day was only seeing a gain of less than 1%. That changed on Friday after the payrolls report, when we closed more than 1% down. But now we are seeing a reversal of that to the upside with a gain of more than 1%. Volatility is working in favor of investors. And I think it's also interesting to take a look at the VIX here quickly. You can see this is a 3-month chart too. We spiked up on Friday, but we are well off of those highs. So even though we have more volatility, just not seeing that fear permeate the market. Here's a 10-year T-note yield down to 4.20%. This is the lowest we've seen in some while there. A very similar story for the 30-year and the dollar as well, also heading down. But I want to show you the sector action today. Only one sector in the red, that would be energy. But in the lead here is communication services. That's where you see Alphabet. That's where you see Meta, as well as Verizon and Netflix. Tech also doing well, up 1.8%. Utilities also outperforming the S&P 500 there. And if we take a look inside the NASDAQ 100, we can really see this broad strength playing out. Forget about Amazon for a second, that's down 1%. Meta's up 3.5%, Alphabet up 3%, Nvidia up 3%, Microsoft up 2%. So some really broad-based gains for not only some of the larger issues here, but the smaller ones as well. And we can see this playing out in meme stocks. Here's that old meme stock board from 2021, updated a little bit, but you can see some of the names which have gotten quite big here. Palantir and Hood each up more than 4% there, as well as some of the smaller names playing out. I will leave us with the Dow Jones Industrial average, and aside from Amazon and Chevron, you're not going to see any red on this board. So kind of speaks to the strength of not only the risk-on flavor of the market, but the volatility working to the upside here.
All right, Josh, Trump firing the BLS chief. You've been following the story closely. What has been Wall Street's reaction?
Yeah, Josh, so of course we got that news late Friday afternoon, and really over the last 72 hours, we've seen a fair amount of reaction from Wall Street economists to this, largely having the sort of take that JP Morgan's chief economist Michael Feroli had, which is concerning news. That was the title of the research note that JP Morgan sent out to clients, and really kind of the consensus among economists that have talked about this. So why would it be concerning news for the president to take control of this if I'm an investor? Very similar, Feroli points out, to the discussion that we've had around President Trump removing Fed Chair Powell. Part of the agreement that sort of investors have with, or markets have with, the central bank, and why the central bank plays a key role, is there's an understanding that they will follow economic data and provide stability to the economy when needed. Of course, if the data were to be messed with for any sort of political reason, that would be a key concern. So economists pointing that out. Neil Dutta over at Renmac highlighting that really all this does is it just undercuts the market's confidence in the data. If there is a new person to come in, how can we then assume that the new person is doing something different? And so it just sort of brings all of these little data points into question for now, and we'll see how it sort of gets resolved, of course, as we're waiting to hear who Trump is going to nominate for that position.
And so, Josh, so bottom line, for investors who are listening right now, what is their big takeaway?
Yeah, the big takeaway from strategists seems to be, okay, another sort of noisy thing coming out of the White House, right? Of course, again, I just made that comparison to what President Trump's been doing with the Fed. This is not something new. If you're an investor in 2025, to have the president sort of attacking some of these institutions that deal with economic data. But what strategists are pointing out is, okay, there's a lot going on with the economy right now. There's signs of weakening. But think about the AI trade and sort of the fundamental story that's being built there. Jared was just highlighting what's working today. What's working today is the large group of tech stocks that beat earnings and revenue estimates last week and are doing better than expected from the fundamental AI story, right? You think about the stocks he was just highlighting, Meta up over 3%, Nvidia up over 3%. That large cap tech trade has had some solid fundamental news in the last week. Strategists say pay attention to that, not necessarily the noise that you're getting on all the other fronts.
All right, thanks there to Josh and Jared. Let's head down to Washington. Ben, what has been going on in the White House, around the whole left in the Bureau of Labor Statistics? Catch us up there.
Yeah, for sure. Josh already laid out some of the Wall Street reaction and sort of how intense it is here. Here in Washington, I think there's a real kind of digestion of how different this is from Trump, from what we've seen him before. You know, I wrote today about how there's attacks from Trump on economic data that go back all the way to 2016, 2017, his first run for president. Obviously, this is different in the fact that he followed through and acted, but it also comes as this second term has really seen a sort of semi-concerted effort from those around him to kind of rethink what they want government data to be and shape it in their own image in the way that Trump is kind of reshaping Washington as a whole here. On one level, it's kind of a change in emphasis is what you hear from a lot of folks around Trump about what they're aiming to do here. It's on jobs numbers. It's not just the overall jobs number, it's the native-born population, focusing on that above the overall number. GDP, there's similar examples there. So it could be, on the one level, it's perhaps a change of emphasis that we're going to keep seeing in the weeks ahead. Obviously, but the larger concern here from Wall Street and from others here is how far Trump's going to go on the underlying data itself. That's the number one concern, and we're going to get a lot of signals from that in the days ahead, from his pick to replace the BLS commissioner, as well as confirmation hearings like that are going to be coming, consuming here in Washington for the weeks ahead.
All right, thank you, Ben. Appreciate it. So President Trump is planning to announce a replacement for the head of the Bureau of Labor Statistics in the coming days. He directed his team to fire the former commissioner after the July jobs report came in much weaker than expected. And revisions to prior months' numbers revealed significantly fewer jobs had been added than initially thought. The president is claiming the report was rigged and that revisions were made up to make the Republican Party look bad. Our next guest, former Trump appointee, disagrees with the president's decision to fire the former BLS head. Joining us now, we have Bill Beach, Economic Policy Innovation Center Senior Fellow in Economics. Bill is also the former Commissioner of Labor Statistics at the BLS, appointed by President Trump in his first term. He served under both Trump and Biden from 2019 to 2023. Bill, it is great to see you. So I guess to start, Bill, let me just get your reaction on that news of Trump firing the BLS chief. What do you make of it, Bill? How important is it? What's at stake?
I was very surprised when he did that. In fact, it caught me while I was in my pickup truck. I had to come over to the side and just sat there for about 40 minutes fielding calls. So what do I make of it? Well, at first it damages the BLS a bit because, as your previous experts pointed out, now there's this cover, this appearance that there may be some bias. That there may be some people working inside BLS to shape the numbers. I can tell you that is simply not true. And it is just simply not the case that the commissioner, especially the commissioner, has anything to do with the preparation of the numbers or the estimation of the numbers. Much more likely that some senior person deep inside the bowels might, but the commissioner is just completely locked out of that thing. But the damage is done. Even if St. Peter was the nominee and was approved in committee and on the floor of the Senate, there would still be this possibility in people's minds who don't follow BLS that closely that, well, a poor month, maybe 25,000 jobs, and they'll say, well, it could have been a lot worse, and it probably was a lot worse, but St. Peter raised the number. So, we're going to take a long time to recover from this. I hope we could recover in shorter amount of time than I'm expecting, but I think damage was done.
Can you walk us through, how does BLS collect the data? Can you walk us through that process?
Well, sure. There are two surveys, and the survey we're talking about, the big revisions, is a survey of business establishments. Somewhere around 600,000. The number varies from month to month. These are surveyed. This is a survey, and as a consequence, it is a sample of the entire 12 million firms that are out there. So we collect that sample in the time period in which the 12th of the month occurs. There has to be a payroll period with the 12th of the month, the date in there. And then the sample begins to come in. By the end of the first month, we have about 68% of that sample in, and it's on the basis of that that the estimate is done. So on the basis of about 65 to 70% of the return sample. Now you notice I didn't say 100%. That's because some firms don't get their sample in, so the period of collection is kept open for 2 more months. By the end of the second month, we have about 83% of the sample in. By the end of the third month, we have 91 to 95% of the sample in. So it's a very complete survey. That sample is collected at the regional level, sent to the national office. In the national office, which is here in Washington, now at the Suitland Federal Center, that there are people who take the sample return and using formulas, mathematics, statistics, they expand that sample up to hit national targets for, say, individual industries like banking or finance or something of that nature. And then on the basis of those, we sum it all up, and that's the national number that's reported first Friday. That's the 73,000 additional net jobs in the economy. So that's basically how it's done.
So let me ask you, Bill, if that's the process, and then we see, on Friday, we see these downward revisions, big, Bill. I mean, to the 2 prior months, we got of 258,000 combined, Bill. I guess my question is, and I think a lot of people might be asking this, are there ways, Bill, to improve the process? Are there ways to improve the methodology you just laid out?
Well, obviously there is. I mean, I don't mean to say obviously, but it is always being improved, really. So what happened in the May and June time period is now sort of unfolding. We can now see more of it. What we got were more returns, and in those returns, in that additional sample for May and the additional sample for June, what was being signaled there was that the initial estimate, based on that 68%, which we thought, well, all the rest of the 30%, 32% will be like that 68%. The rest of that sample was not like the 32%, that 68%. It was our estimates were too high. So on the basis of additional information, the estimates were lowered, as you pointed out. Now, what was happening? We think it's coming from state and local education primarily, and from seasonal factors. So let's go with the state and local. What might be happening there is that educational institutions were running out of COVID money, and they had used a lot of COVID era money to boost their staffing. The end of that money came in 2024 and 2025. And so we now have less hiring. That's one explanation. We're going to find out more. The point is that revisions were made when we had additional information. It isn't that the first one was wrong in a sense of that we didn't carry the one and add the two. We just got more information. This happens, by the way, Josh, all the time. Every month there are revisions to the sample. Pardon me for that. All revisions to the sample, and so nothing unusual here, and I don't think anything was really defective. We can dig into that a little bit more if you'd like, but that's basically what happened.
Can I ask you, Bill, who you think should lead the BLS next? Who should be a candidate?
Someone who's very well qualified. I mean, right now we're looking at someone to come into BLS and do some triage. So it needs to be I think a person who has a reputation, has been established. It needs to be someone who's not overtly political. Clearly, the president has the right to appoint anybody. This is a presidentially appointed, Senate confirmed position, but it's going to be hard to get it through the Senate if you've got someone who is even slightly suspected of hoping to use their position to influence the numbers. Boy, I tell you, that would do so much damage to markets and create such great risk and uncertainty. BLS is the gold standard in the entire world for a statistical operation. It would be a disaster if that gold standard were tarnished.
Can I ask you a final question here, Bill? Does money play a role in any way? Does the BLS require more funding?
So we need to make improvements, and to make improvements, we need to have some money for innovation. if you're going to improve the jobs numbers and you're suspicious that perhaps the adjustments are too big, you're going to want to make your improvements, run them side by side with the old system. And once it's proved out that your new system is working as well as the old system, maybe better, then you can drop the old system and implement the new. But for a while, you have to run at a higher cost. It's not like we can just drop the old system and experiment with the new system. These numbers need to be really, really good. So yes, we need more money. BLS has had flat funding for years and years, in spite of the fact that we've had a lot of inflation, as everyone on your audience knows. So we need more funding. We actually need more innovation, and perhaps it's just as important for the Congress and the president to look at BLS and say what's important, what's not in the activities that they're doing, and really focus on the important parts.
Bill, so appreciate your time today. Thanks for joining us.
Thank you so much.
We are just getting started here on Market Domination. Coming right up, could a market correction be on the way? We're taking a deep dive into what a possible pullback of the major indices may look like. And investors will be watching for Disney earnings results this week, and some analysts may be feeling very confident about that business. We're taking a deep dive there. And people may want to spruce up their homes more than usual with fresh furniture, and that may be helping one online retailer. We're taking stock of Wayfair's earnings results. We'll have those stories and a whole lot more coming right up on Market Domination. Despite a strong run currently for the markets, August can historically be a tough month for investors, and some are wondering if a pullback is possible. Let's bring in now Sam Stovall, Chief Investment Strategist at CFRA Research, to discuss. Sam, my friend, it is always great to see you. So I'm looking at the screen here, Sam. Green everywhere today, my friend. So, that's after, obviously, Friday's decline. But where do we head from here, Sam? What are you telling your clients?
Hey, Josh, good to talk to you again. Well, what I like to tell people is be prepared for volatility, because then they won't be surprised by it, and as a result, act upon their emotions, because you know as well as I do that emotions can become a portfolio's worst enemy. So I point out the fact that August and September have posted average declines since World War II. September has actually fallen more frequently than it has risen. And also every August of the first year of a second-term president has been negative, going back to Dwight Eisenhower in 1953.
If we saw a pullback, Sam, I'm curious how you think investors would respond and react. Would they jump right back in there? Would they buy that dip, Sam?
I think they would, because they've been taught so much to do that, and also because we had very strong earnings from many of the tech sector participants. Also, tech up 17% year on year in terms of the June quarter results, as compared with about 7% for the S&P 500, according to S&P Capital IQ. So I think investors say, you know what? We realize that we've already had a 19% decline thus far, and history says that whenever we then have a second intra-year decline, that it's has never been above 10% following that correction. Of course, history is a great guide. It's never gospel. But what it does imply is that if we have a second intra-year decline, it's more likely to be a pullback than an outright correction.
The economic data, Sam, we've been getting here would seem to suggest some weakening. And I'm just curious, as a strategist, what you make of that and what you think the Fed makes of that, Sam.
Well, you're absolutely right that weakness is something that investors are worried about. I like to say that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And with the most recent jobs data coming in much weaker, combined with the revisions to prior reports, people were whispering the R word. Well, the National Bureau of Economic Research is the group that tells us if we're in recession. And they look at 5 different indicators, including GDP, industrial production, consumer confidence, retail sales, and unemployment. And while, yes, you could say that we could see some softening in the third quarter, primarily because of the impact of tariffs, expectations are that we're going to be climbing out of that soft patch in the fourth quarter and the first half of 2026. So I would say right now, yes, softness is a possibility, but we still are not anticipating a recession.
Sam, curious to get your thoughts on this earnings season, how you would characterize it, Sam, and your forecast for corporate profit growth ahead, given your expectations for the economy.
Sure. Well, what's interesting is, what do they say? Prices lead fundamentals. And we had a 19% decline from mid-February to early April. Well, only during that period did we start to see downward revisions to earnings estimates. We started 2025 expecting to see a 13% gain in earnings. That got whittled down to 9% by the end of March, and then less than 7% by the end of June. Now, however, we're climbing our way back up to about 8.5%. So as the market recovered, so too I think that earnings will be recovering. And then as we look to 2026, 13% is the estimate that we see for 2026. And the good thing is that all sectors are expected to post year-on-year gains, with a majority posting double-digit gains.
Speaking of sectors, Sam, where do I want to be overweight? What do I want to avoid here?
Well, we're still overweight the communication services and the information technology sectors. Basically, what I like to do is focus on those groups that were beaten up during the market decline, because they tend to end up being the outperformers in the recovery period. So through July 28th, which was the recent high, while the S&P was up 28%, the three worst performing sectors during the decline, communication services, consumer discretionary, and tech, were up 37%, and the 10 worst performing sub-industries were up 44%, and they included independent power producers, semiconductors, diversified financial services.
I was speaking to another strategist, Sam, and it's interesting. She told me she was getting kind of uneasy after this bounce off the April low. And one reason, not surprisingly, Sam, she brought up for her unease was valuation. And I'm just curious how you would broadly characterize valuations here. Are we looking stretched, Sam?
I think we are looking a bit stretched. If you look at a 20-year average, we're trading at 2 standard deviations above the mean on the S&P 500 based on forward 12-month earnings. If you shorten that to a 10-year average, then we're trading at 1 standard deviation above. But as a lot of tech analysts like to say, well, so much has changed that really you probably should only be looking at a 5-year average. And in that case, we are within a standard deviation. So I would tend to say that until we find other areas to be much more attractive, or indeed the market is convinced that we are headed for a recession, I think investors are going to, like whitewater rafting, let the market take them where it wants to go. They're going to stick with the growth areas for now.
Sam, always great to have you on the show. Thank you, sir.
Thanks, Josh.
Now time for some of today's trending tickers. Yahoo Finance senior reporter Josh Schafer joining me here to break it all down. We're taking a look at Coinbase, at Disney, also Wayfair. Starting with Coinbase, that company hit with a downgrade at Compass Point. The firm lowering its rating on that stock from neutral. They go to a sell, Joshua. They target, let's see, 248, they tell clients. Now, of course, they did report earnings and sales that trailed estimates for the quarter on July 31st. Compass telling clients here, while we remain constructive on the current crypto cycle, we expect a choppy Q3 alongside weak August and September seasonality and a waning retail interest in crypto treasury stocks.
Yeah, and they also added in there, Josh, that they see limited support for Coinbase's valuation at this point, right? Coinbase has been a stock that has participated very well in the rally from the April lows, and sort of saying that they think if crypto markets were to sell off further, that would be a key impact for Coinbase. What's interesting is you see a call like this, you're talking about a crypto sell-off. I just took a look at Bitcoin prices. I mean, Bitcoin's $115,000 a coin. So it's not like you've necessarily seen a broad sort of crypto sell-off, but Bitcoin is one of those assets that folks are going to talk a lot about seasonality. It has traditionally moved pretty regularly at different points in the year. So if that's sort of the risk you're looking at, then I mean, that's your case, right? But it'll be interesting to see as we talk about a lot of this economic macro uncertainty, where are investors going to go if there's growth concerns? Does Bitcoin become a defensive play as it has before? And is that a boost for Coinbase, or is that not quite how things play out? But again, with Coinbase, obviously, a lot to chew on here, and at least one sell rating for now.
Yeah, companies also say they expect increasing stablecoin competition to weigh on both Coin and Circle's valuations in the second half. Meanwhile, let's look at Disney as well, getting a price target lift at Morgan Stanley. That firm highlighting earnings growth potential for the media giant if the macro backdrop remains healthy. So Morgan Stanley, Josh, they raised the target on Disney. They go to 140. They maintain the overweight, so they are still believers. They say if the macro backdrop remains healthy, we see Disney generally healthy double-digit adjusted EPS growth in the years ahead. They talk about thanks to growth in its experiences and streaming businesses, they say it is poised to have rebuilt its pre-pandemic earnings base and hit new highs by 2027.
And what stands out to me in this call, Josh, is you mentioned the growth in streaming and content sales that's kind of off, and what they point out is it's offsetting a flattish ESPN and declining linear entertainment segment. You and I, of course, know, everyone knows, the linear entertainment segment declining is not a new thing that's happening this quarter, right? That's a secular trend story that we've been talking about. But ESPN being flat is interesting to me because the New York Times was out reporting last week that ESPN and Disney have made a $1 billion deal for NFL media rights. They said, Josh, that on Wednesday they're expecting during the call that Disney will announce that they've made a $1 billion deal that will include getting NFL Red Zone, a very popular streaming product on Sundays for us NFL fans, onto ESPN. And I'm curious if that deal does indeed get announced, what street analysts are going to make of that. I mean, the NFL is the largest live streaming sports product that we have here in the US. Most of the top watch shows on TV every year are NFL games. Right now, ESPN really only has Monday Night Football. So if they were to able to get something like Sunday Ticket and they're launching this new streaming product, I'm just curious how analysts are going to sort of digress that and what it means for the growth story. Feels like a decent opportunity when you just think about the popularity, of course, of the NFL.
Yeah, I can't remember what I paid for NFL Sunday Ticket.
It ain't cheap.
I remember it being notable.
Yeah.
And I'm going to do it again.
Right.
All right, and Wayfair reporting better than expected results for the second quarter. Earnings surpassing Wall Street's expectations as the home furnishing retailer reports its highest revenue growth and profitability since 2021. So this one, online retailer reporting second quarter results, Josh, better than expected. I did see Bloomberg analysts who know this name saying better than expected results suggest, they say, the worst is behind and the home furnishing retailer may be on an upward trajectory. Stock is up around, I think, 60% this year.
A home furnishing stock that is up 60% this year and 12% off earnings, and all we've been talking about is tariffs since the start of the year. Wouldn't have guessed it, right? And I just think that's kind of the epitome of this tariff story is certain stocks that you would circle and just be like, well, there must be tariff exposure there. Wayfair is bringing in things from all over the world. They have to suffer from that, right? And that is not necessarily how it has gone on a stock-by-stock basis, right? Yeah. Interesting to point out the folks over at Jefferies just highlighting that they were really impressed with that revenue growth coming in above expectations, and they feel like these are solid results with profitability going higher. They have a price target, though, of $60. So you do start to wonder as we talk about this rally, Jefferies overall positive on the stock, but the price target actually below where the stock's trading as we've seen this rally this year.
All right, well, coming up, Fed Governor Kugler's seat opening up sooner than expected. We're taking a deep dive into who may fill her shoes. That story and a whole lot more coming up. Stay with us. President Trump is set to name a new Federal Reserve governor this week. This comes after Fed Governor Adriana Kugler, a Biden appointee, announced she is stepping down from her role at the central bank. Kugler's term was set to expire at the end of January 2026. Joining us now is Loretta Mester, former president and CEO of the Federal Reserve Bank of Cleveland. Loretta, it is great to see you as always. Let's start there with Kugler's departure, Loretta. What do you make of it, and who do you think could replace her?
Well, I mean, it gives the president a bit sooner opportunity to appoint someone onto the board. Of course, Adriana's term was going to end in January. This, brings up a couple months early the appointment. So, I mean, the president's going to have to pick somebody that'll get confirmed by the Senate. So, there's probably a short list of people he's thinking of. But it also gives him the opportunity to appoint someone that he will appoint then as the chair or as the vice chair. So it's a real opportunity for him to put his stamp on the Fed in another seat. So I'm sure he's going to be looking at a lot of people, and we know who's been on the list of potential chairs. So maybe one of those people will be appointed, but we just don't know. I'm sure there's a lot of viable candidates that the president's looking at.
What do you make broadly, Loretta, of kind of the president's increasing political pressure on Powell?
Well, it's very unfortunate. I mean, the independence of the Fed to be able to make monetary policy, focusing in on the longer term goals of price stability and maximum employment, and insulated from short run political considerations, is really one of the tenets of effective central banking. And it's been proven in research and practice that when you have that kind of independence, or when a central bank has that kind of independence, you end up with better outcomes for the public. You get lower, more stable inflation, and you don't face a cost of more variable output or employment to get that low and stable inflation. So having the president go after the Fed chair, it won't change how the Fed goes about making its policy decisions. They're going to still focus in on evaluating incoming economic and financial information, using models, using scenario analyses to come up with a view of where the economy is going, where the risks are, and what's the best policy path to achieve the dual mandate goals of maximum employment and price stability. But it does complicate the process of monetary policy making, because the Fed now has to spend time trying to tell both the public, the legislators, and financial markets of what the fundamentals are that they look at, and what things like the president's comments they do not look at when making policy. And so it's an unfortunate situation that undermines the credibility of the Fed's process without really any gain, as far as I can tell. It doesn't change what the Fed's going to do or the way it goes about doing it. I think it's sort of detrimental to one of the goals that the president says he wants, which is lower long-term interest rates. In fact, if the Fed were to lower interest rates, short-term interest rates, its policy rate, disregarding what is appropriate just because the president wants the Fed to do so, I think long rates would go up, not come down. So that undermines that goal. And it also makes it much more complicated for whoever the new chair is going to be, because that person is going to have to really build credibility with the public, with Congress, and with the other members of the FOMC who vote on monetary policy. So again, I don't see any gain from this, and I only see costs.
I have seen Mohamed El-Erian, Loretta, give interviews to the press, and he's telling reporters he thinks Powell should step down. And his argument seems to be, Loretta, well, if Powell stepped down, that would actually sort of diffuse the situation you're describing there. It would minimize the attacks, and in so doing, it would actually help preserve the Fed's integrity and independence. What do you make of that argument?
I couldn't disagree more with that. Firstly, anybody who thinks they can kind of game the administration and the president on any of this, I think is incorrect. I mean, I don't think you can sort of think down the tree that way. I think the best way to preserve independence is for Jay Powell and the Fed to be doing exactly what they're doing, which is focusing on their mission, the dual mandate goals, doing the hard analysis, bringing as much data, analytics, scenario analyses, forecasting, to really evaluate where the economy is, to evaluate and balance the risk, and to then set monetary policy to achieve those dual mandate goals, and really focusing in on doing what it always does, which is really care about the long-term goals that Congress has given to it, and ignoring other things that could be a distraction from those goals. And I don't see any reason that Jay stepping down, Chair Powell stepping down, would further the mission of the Fed in any way.
There is a question being asked, Loretta, in certain political circles, so I want to get your take on it. I'm sure you've heard this question. The question sort of is framed like this: why did the Fed cut late last year, an election year, but won't cut now, even as inflation has calmed down? What do you say to that?
Well, it's doing the same kind of analyses, right? Back in September, it had gotten some reports on the labor market that ended up being looking weak. And so it ended up starting, and inflation was actually still above goal, but it had been moving down. And the forecast was that it would continue to move down, and there was more evidence that the downside risk to employment had risen. And so it did the evaluation, balancing the risk, and thought at that time, okay, it's time to start reducing the level of accommodation. Because remember, at that time, right, the monetary policy rate was high. So it started that process. And in fact, it even cut 50 basis points rather than just the 25, which is more typical, because it was concerned about employment. Of course, some of that weakness in the employment data got revised away later on, but nonetheless, right, the Fed was on that path. When this year came, it looked like inflation progress had stalled at the beginning of the year. And then when the tariff announcements came out, those tariff rates were quite high, with the potential of really raising inflation, perhaps in a one-of way in terms of prices moving up, inflation moving up, and then inflation falling as the new price level, higher prices were achieved. But nonetheless, potential for inflation to move up and maybe persistently up. And so it had to balance that risk against a labor market that looked like it was in balance, and we had achieved, or the Fed had achieved, maximum employment. Now it's going to do the same kind of analysis. It's going to look at the recent data, which showed that the labor market momentum has really stalled, and that labor demand has been weaker than expected. The bottom isn't falling out of the labor market, because supply has also moved down, but nonetheless, the downside risks to the labor market have again moved up. But there's also evidence that we're now starting to see prices move up for particularly the goods on which there's tariffs. That could be a one-of movement in prices up for goods that are tariffed, but it also has a potential of leading to broader based inflation. They're going to have to continue to evaluate. There's a lot of data coming in before the September meeting. I think they'll walk into that meeting with an open mind. They'll do the evaluation that they do, and then they'll decide what's the best path for policy to balance those risks, which have shifted since the summer.
Would you, Loretta, and granted your point is well taken, a lot of data between now and then, but in September, would your bet be that we see a cut?
Well, it really does depend on how things come in. I mean, the way I view it is, look, we know the downside risks to employment and labor have moved up, right? So employment's considerably weaker than we thought. But we also think that inflation, right, we're starting to see those prices move up. But if we continue to see the service side of prices continue either staying where they are or moving down, I think you can make a case for a 25 basis point cut. But I also think, right, there are going to be people on both sides of the issue. Some are going to say, we've already have a level of the funds rate, which is not that restrictive. And so since inflation is still elevated and moving up, we should hold pat. And others will probably balance the labor market risks as being the more significant one at this point, especially for those who think that policy is restrictive and perhaps more than modestly restrictive. There's some who think it's moderately restrictive. They could cut 25 basis points and still have a restrictive policy rate that'll work on inflation. So I think there'll be people on both sides of that. But again, we can't say today because we don't know what the data is going to be. We're going to have to see the labor market data and the inflation data to get a better view of what that progress going forward looks like on those mandated goals.
Loretta, always great to see you. Thanks for joining us.
Thanks very much. Take care.
Coming up, oil prices drop and intraday trading. We'll recap what's going on with the commodity and why. Stick with us for a deep dive into the latest oil headlines. President Trump's firing of America's chief of labor statistics continues to raise questions about whether data is truly free from partisan spin. Former Commerce Secretary Wilbur Ross spoke with executive editor Brian Sozzi about trust in the numbers, and he weighs in on the dismissal.
I think what is a little bit suspicious about the most recent BLS data is it came out shortly after the Fed FMOC meeting where Trump was hoping to get rates reduced. And clearly, if the two big revisions had come out before the meeting, it would have been more likely that the FOMC would cut rates. And that's the second time that that sort of suspicious behavior occurred. Remember, just before the presidential election, they also had 2 months of very good labor results. And then a day or two after the election, they made a massive correction in both months. Again, had that been out before the election, it would have been helpful to Trump. So I can understand why he would be suspicious, at least of the timing. As to whether the underlying data themselves are correct, I would really have no way to know. But it is a little spooky that there were two recent events, big numbers, big changes that could have helped Trump had they been more timely.
Do you believe, Mr. Secretary, before we get into the trade, like the president noted on Friday after the numbers were hit, that this data is rigged, not only the jobs data, but perhaps other data that the government provides?
Well, I think that's just speculation. He certainly never tried to influence the data that came out of the Bureau of Economic Analysis, which is part of Department of Commerce. We never had any problems like that during my term. But we also never had the kinds of events that I just described to you that naturally make one a little suspicious.
Mr. Secretary, on the trade front, since we last talked, tariffs have stayed in place for many countries. I mentioned Japan at 15%, Switzerland now at 39%. Are tariffs the new normal for the duration of the president's second term here, in your view? Or is there an opportunity to take these 15% tariff rates that Japan is now paying and negotiate them down further?
Well, I think the president has made clear that if there are further reductions by other countries, that he would take that into account. So his target is really improving our balance of trade. That's one of his major objectives. And that can either be done by holding back the trade of foreign countries through tariffs, or by everybody cutting it together. So I think trade policy will continue to be a centerpiece of his administration, but that doesn't mean everything will be increasing.
What gets a deal with China over the finish line?
Well, China, as you know, is going to be having their big party Congress very, very shortly. And as you may know, I've felt for some time that it was unlikely that they would make a radical change in policy before the party Congress. They don't normally do that. And I think that Congress is either this week or next week. So we should know pretty soon if anything different will come out of that. But certainly the news that was out today about the critical materials being still restricted, that was not very encouraging.
Mr. Secretary, the fact that China has not solidified a deal with the U.S. on trade, is it likely then that its tariff rate will be higher than what we saw from the likes of Japan and, of course, the European Union?
Well, it's up pretty high right now, and it's I don't know whether he would make it even higher, but you know, once you get to about 30 or so % on the tariffs, it doesn't make too much difference if you go beyond, because 30-odd % is very, very hard for a country to absorb. And as a result, 30 or so percent is the demarcation between are you going to be doing trade with them or not?
Okay, Mr. Secretary, always nice to get some time with you. Appreciate you coming on. Of course, the Secretary is the author of the book Risks and Returns. We'll look forward to talking again soon.
Oil futures are sliding. This coming against the backdrop of OPEC plus hiking oil production and potential supply disruptions linked to Russia. For more, we're bringing in Yahoo Finance senior markets reporter Inez Ferre. Inez.
Yeah, Josh, we saw Brent today down more than 1.5% and WTI also down almost 2%. This is because of that September output hike from OPEC plus. Now, Goldman Sachs says that they do not expect any more hikes from OPEC plus. This pretty much now unwinds the 2.2 million barrels per day, those voluntary cuts that they had installed over the last couple of years. So for now, this should be the last output hike. As far as Brent futures are concerned and where they're going for the rest of the year, well, Goldman Sachs is saying that they're going to go lower. They're predicting $64 per barrel for Brent by the fourth quarter of this year. So we're about $4 away from that. And also, as far as 2026 is concerned, they're predicting that Brent is going to go down to $56 per barrel. They're talking about more supply coming into the market with non-OPEC members that have new production coming on, like U.S. shale, like Brazil, also Norway as well. So that really limits the amount of more of output hikes that OPEC plus could do without creating a surplus, Josh.
And Inez, we also saw some headlines about India's oil purchases from Russia. What can you tell us about that?
Yeah, so, well, President Trump has really been pressuring India to stop purchasing oil from Russia, essentially basically saying that they are funding Russia's initiatives in Ukraine, in the war in Ukraine. So Trump saying that he will substantially increase tariffs on India, but Indian Prime Minister Modi has said they're going to continue buying Russian oil. He also said that Indians should purchase domestic products. I will say that what Wall Street is looking at is if Russian production were to somehow be compromised or if that would be decreased, then you should see an upside risk to oil prices. In this case, India is kind of stuck in this sort of push that Trump has been doing in order to end the war in Ukraine, and him using tariffs and pointing to oil purchases because India has been a big buyer of Russian oil since the war in Ukraine started.
All right. Thank you, Inez. Appreciate it.
Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.